I tell you, weather breaks like this, people get excited. I think you mentioned last time you were on, we're coming in tax season. People get that money and they want to spend it, but maybe they could do some other things with it.
Well, no doubt about it, Luke. With personal finance, even little things matter, right?
Mm-hmm.
Okay, so a lot of people are going to get a tax refund back, and so then the next question is, all right, what can we do with this tax refund? Okay, and there's a lot of things that can be done with it. The hope is that you pick something that helps you financially, right? And that versus going out and just spending it again, And so, with that being said, one of the other shows, I'd like to maybe get into that a little bit more. Some things that can be done with it. This time, I'd like to talk about tax basics, right? Just about understanding how it basically works. Okay. Now I know there's a lot of people that know that, right? The thing is when you just know the basics, right? Then you can plan what you want to do with it, right? And how you want to use it to your advantage. It's income tax time, and everybody, it's like, right?
Yeah.
Okay. But it can be used to your advantage, right? And so, my goal when it comes to taxes is to pay as little as possible, zero if I can, and so, but and I look at it as two levels, right? I look at it at base level, which is, all right, here's things that everybody knows about and can do. And then there's these other things that people are like, well, how does that work? Right? And how do I get to that part, right? And a couple of those, like operating a business, okay? And operating one for tax purposes. That's kind of like level 2, right? But again, it's nothing that's really it's not out of anybody's reach. So with that being said, I guess I'd like to start with just how things are set up, right? Okay.
So this is the base.
This is the base,
Okay.
right? We have for income taxes, right? We have fed, state, and local, correct? Okay. And so the federal tax is where we have the biggest advantage to use it to our advantage, right? Because we have more deductions that we can take in that area than in the state and then in the local. Okay. And the state would be next. All right. They give us a little bit, right? Give us a little
Right.
bit of play. And then local, we don't really have a lot of play at all, right? Okay. But also the taxes are, feds a little bit bigger, state a little less, right? Local a little bit less, right?
Yeah.
Okay. For our, our rates. And so that's one of the first things, right? So understanding how that's figured out, right? So, and I don't know if your viewers can see that, right? But this is the basic tax calculation, right? We start with our gross income, and then we have these things called adjustments to income, right? And so that's where we have things like our 401k, our IRAs, things like that, where we can make adjustments, right? And then we have, after that, we have our deductions, right? So everybody hears of the standard deduction. Everybody hears of itemized deductions, okay? A lot of people don't know what itemized deductions are, right? So real quick, all that is a list of deductions that if they add up to more than your standard deduction, you want to take them, right? Because you get a bigger deduction from your income, all right? And then that gives you something called your taxable income. And then you have, after that, maybe some credits, okay? Now, credits are fantastic, and yet they're not, okay? All right, so let me give you the difference.
Okay.
So a credit is a dollar-for-dollar deduction from your taxes. So if you owe $100 in taxes and you have $100 in credits, you owe nothing, all right? Where a deduction is a deduction off your income, which only reduces your tax a little bit. It's not a dollar for dollar on your deductions, okay? But the thing is, usually when you're getting credits, okay, usually you have a lower income, okay, and or the big credit everybody knows about is kids, right? Well, please don't be going out and having kids for a tax deduction. All right, I don't have kids. All right, my brother has 4. He took care of that for the family, but.
You were a teacher, so you had thousands of kids over your lifetime.
Exactly, right? I could mess with them for 42 minutes and then send them out the door. But you have the child credit, right? So that is a good example of a credit that you can take. And so that's the basic layout, right? So when you're messing with your federal taxes, I want to talk about federal taxes, I guess, more than state and local, because this is where we have our biggest chance to use them to our advantage, right?
Right.
So we want to look at that adjustments to income. So what's in there that we can do, right? And what's in that, what's the standard deduction? What's this itemized deduction thing, right, that we can take advantage of, okay? Now, with that being said, a couple things other that, we should be looking at, right? So if you look at the tax rates for the Fed, right? So I think it's a single, right? So this is a single tax rate chart, right? Okay. And so with that, you'll look, there's two areas that if your taxable income is going to fall into these two areas I have marked with the arrows, like you want to adjust your income, right? Okay. So if you look like the first one, there's only a 2% change in that section right there, right? But by gosh, there's a 10% change right there. So if I'm in this where I get this 10% jump up, then by God, I want to get back down into this 12 and 10%, right? Same thing with this section here. This is an 8% increase, right? Versus what, a 2% increase there. So if I'm looking at my taxes, I want to, if I'm going to fall into those two categories, then by God, I want to try to at least get down to that next category. All right. And so this is for single taxpayers. Married taxpayers, yours, same two categories, really, right? So there we go. I think I'm straight now on the thing here. So same two categories. If I'm going to fall into those two areas, I mean, that's a chunk of change. I don't know about you, but I'm probably not averaging 10% on my investments. Yeah. So with that being said, when you're in those areas, let's try to get that down so that we can get down to those lower percentages, versus, taking what they're given, right? The question is, well, how do you do that, right? Okay, and so the basics are that we have these things. I should have let you sit down, right? Okay,
I can go back.
That's okay, and I'll just look at them here and go from there. All right. So example, right? So 401k contributions, right? So if you have a 401k at work, all right, and it's available to you, and it fits into what you want to do tax wise, there's one way to start lowering that taxable income, right? Okay, so I don't want to say it's hid from the federal government, but it's not taxed, right? So in your paycheck, if your paycheck's $1,000 and you put $100 into your 401k, the government only sees $900, right? Or you only get taxed on $900, probably
Right.
a better way to say
Yeah.
it. Same with IRA contributions, right? So if you're contributing to your IRA, you get a deduction for that. Then there's these itemized deductions, all right? Now, itemized deductions used to be a little bit easier to get into, okay? They're not as easy to get into as before. And I don't know what exactly the timing was. I know it was when the last tax cuts came through, okay, where they raised the standard deductions. And that helped a lot of people, and it also hurt people, okay? Anytime that there is a change to tax code or whatever, some people are going to be affected and other people are going to be affected a different way because it's just the way it is, right?
And you hear a lot about that, like in assessment, property assessment, right? Because people are like, why doesn't the county do reassessment? Well, like a third would benefit from it, a third wouldn't benefit from it, and then the other third nothing would change.
Exactly.
So
yeah, and so back in the day, if you bought a house, right, you were pretty much in itemized deductions. Okay, not so today. Now, if you're a single person, it's a lot easier to meet the limit that you need to get into itemized deductions versus if you're a married couple. Okay. So example, standard deduction for a single person is $14,600. All right. Standard deduction for a married couple is $29,200. All right. So, if a single person buys a house, right, they only got to hit 14.6. A married couple buys a house, they get a 29.9 or 29.2. So, it's a little bit harder now for a married couple to get in than it used to be. Okay, and depending on how you had your taxes set up, and that it may have been a little easier than that. So, but that doesn't mean that it didn't help people by them switching to standard deductions also, right? That and so let's talk standard deductions real quick, okay? And I don't know why the federal government did it this way, but basically they said, all right, it's based on marital status, right? So if you're single and married filing separate, which is $14,600, which means you can make up to $14,600 before you owe a dime to the federal government, okay? Married filing joint and qualifying survivor spouse, okay? Used to be called widower, is $29,200 before they tax a dime of your income. All right, and then head of household last is $21,900, and same thing. You can make up to $21,900 before the federal government taxes a dime of your income. Okay, and so this is one of my pet peeves, right? Okay, if I came up to you, Luke, and I said, "Listen, will you give me $10 out of your paycheck every week, and I'll just give it back to you at the end of the year"? Are you like, "Hey, yeah, sign me up for that"?
I'll give you 20.
You give me 20? I appreciate that. No, right?
Right.
Okay. So, and that's what we do. We give the government an interest-free loan for the year. And there's certain categories of people that don't need to do that, right? And so, the big category that comes to my mind are young people, right? Especially kids in high school and college, okay? Most of them can't work enough to make $14,600, right? Okay, and so on their W-4, all right, their W-4, folks, is the form that you fill out for when you start work, and it tells your employer how much to take out of your paycheck. Well, on that form, that you can write exempt. Okay, so your tax professional to figure out where to write that on. So if you know that you're going to be under $14,600 and you're a single person, right, or married filing separate, okay, then why give it to the government for a year to hold it just to get it back, right? So, and this comes into knowing about how to use money correctly, right?
Yeah.
So now the question then becomes, okay, if I do that, now do I just get that money and I just start spending it? Or do now I get that money and I do what the government did with that money? Right? They put it into some kind of interest-bearing endeavor so that they get some money back, right, on that.
'Cause you're not getting that interest.
Exactly, because we're not getting that interest, are we? Yeah. And you don't get your money back unless you file your taxes to get your money back. So things like that, where it's let's not give the government any more than we need to. I'm not a big government conspiracist or anything like that. It's just why, right? Why do it? And little bits, so people go, well, it's only $100. Well, it's not just $100. That little things, every place you can save little pieces, now they become big pieces.
I think you talked before about making your money work for you, right?
Absolutely.
And that's a case where you could take that 100, put it in something, and start building some interest off of it. So that's, again, that 100 isn't just 100, as you're saying. You can do something with it.
Absolutely. And it's not just interest. It's not just putting it in a bank, right? Okay. So I'm sure you've heard of the rule of 72. Okay.
Yeah.
So for those of you out there who haven't heard of the rule of 72, what you do is you take the number 72 and you divide your interest rate into that number, okay? And that tells you how long it takes your money to double, all right? So we're not making money in savings accounts, folks, all right? Now, that doesn't mean there's not a place for them, right? That's the other thing, is you have to look at your investments and say, all right, what is this meant to be used for, right? So if you take a savings account, okay? Savings accounts are not intended to make a ton of money, okay? So let's say, I don't know, I'm going to guess 1% is what most people around, maybe even under 1%. And some I'm sure over 1%, you know, but 72 divided by 1. How many years is it going to take our money to double? 72 years.
Yeah.
Right? So if I got $100 in the savings account, I'm going to have 272 years. Right? No. Okay. We're not making money. But that savings account is meant for three things, right? Emergencies, paying bills, and a place to put our money till we know where to put our money. Right? Okay. And so now we get that tax refund, whatever it is. All right. And we stick it over there in that savings account until we say, all right, what do we really want to do with this? Okay. And it could be something like moving it into a mutual fund, right? Moving it into a Roth IRA, moving it into whatever. Okay. Or it could be, let's use that money in a business adventure, right? Maybe it's something small. Maybe it's buying and selling stuff, right? You know, maybe microphones. Right? I don't know squat about microphones, but you know, maybe you're at an auction and you see a microphone there and you're like, hey, that's a good microphone. And you got $100 from your tax return, right? And you see this microphone's $25 at an auction, and you can turn, and now there's a difference between know and think, right?
Yeah.
Okay. Man, that thing's worth 500. Well, right away you can double your money, right? If it's worth 500, you buy it for 25. Now you can turn around and sell that bugger for 50, right? And it's going to sell. So, you can do things like that too. And that helps everything else, right? And I don't know, there used to be a TV show on, I don't remember the name of it, but, they started with an object and they had to keep trading up, right? They had to.
Oh, that's funny.
Do you remember? So, I don't know, like you start with a pencil and then you had to trade that pencil for something else of value. And the goal was to see who could take that original object and end up with the most increase in income based on what they've done with it, right?
That's fantastic. Hey,
Seriously.
let's do this real quick. You're
Yes.
watching The Morning Drill on Stream TV and on the Armstrong Neighborhood Channel. Gary Glunt with us here this morning. That's really cool. How old was the show?
I am so horrible with dates, Luke. I really am.
Okay.
But if I had to guess, I'm going to say like 10, 15 years ago, somewhere in that category. I'll look it up and add for next time.
Yeah, that's cool.
And see what that was. And that, so let's take a look at some of our deductions, right? Okay. Let's go to itemized deductions. Okay. So how this works is this. All right. Some of them are. I'm going to touch the basics of them, right? I'm not going to dig in and do the nitty gritty. Okay. But basically, so let's say you buy a house. Okay. So if you buy a house, you can deduct your mortgage interest and something called points off of your taxes. Okay. And points, I wish I had picked a better name for it. I can't stand that name. The basic gist of it is you can pay a bank money to get your interest rate down. And that is called points. Okay. And so, but that's deductible if you do that. All right. Then there's your property taxes. Okay. So if you have a house, you're going to have property taxes, right? So you add those two together, see what that comes up to be, right? Okay. Then there's your state and local income taxes. So on that paycheck where you have your state income taxes and you have your local income taxes, now you can deduct those on your federal. You put those three together and see, are they above my standard deduction? And if they are, you say, all right, we're going to take the higher of the two numbers. Okay. Then there's gifts to charity. So if you got those three and now you give money to charity, right, or whatever, it's any combination of these, right? It's not that you have to have a home first or so on. It's any combination of these that puts you over the standard deduction. And casualty and theft losses that I believe are not covered by insurance. So you can't double dip, right? You can't have something stolen from your house, turn in your insurance, and then deduct it off your taxes. Okay, and then medical and dental expenses. Okay, And so if you have medical and dental expenses, again, that are not covered by insurance, those fall into that itemized deduction category. Okay. Now there's medical and dental expenses. There's a threshold that you got to meet before you can take them. Okay. And the same thing with casualty and theft losses, right? There's a threshold that you have to make before you can actually start taking some of those. Okay. And what I mean by that is this. So let's say that, and I don't know exactly what the threshold is off, it's 7.5%. Okay. So I don't know if you have $100 in medical and dental expenses, and then 7.5% of those you're not going to be able to take. So $7.50, right? So the rest of that you would be able to put into your itemized deductions. And that you know what, I said that wrong. It's 7.5% of your adjusted gross income.
Okay.
Not of the amount that you have. All right. So whatever that 7.5% would be. All right. Hey, so I don't want to get in deep in that, but let's do it this way. Let's say your adjusted gross income was. Give me easy numbers here, Luke. Let's say it was $10,000. Okay, so 7.5% of $10,000 is what, $750. All right. So if your medical and dental expenses were $100, you couldn't take them. All right. If they were $1,000, you could take 250 of them. Okay, so that's that threshold thing. All right, and so again, if you add those buggers up and they're more than your standard deduction, take them. Right? If the government says you can do it, why not? Right? And and so that's I look at those things. Right? Your 401ks, your IRAs, your itemized deductions. That's like, we should all know about that. Right? We should know that those are things that we can do. And then we say, well, how can we take advantage of those? Right? How can we use those, or do we not want to use those? Okay. Tier 2 are things like running a business for tax purposes. Okay. And things that they call like capital losses. All right. Buying and selling something with that a loss occurs with it. Usually that occurs, of course, if you have investments. Okay. And now, same thing, in that when we don't know about these things, we go ask, right? We go ask the people that know what they're doing. And you'd be surprised at how many people are out there and want to help you. There's a lot.
Gary, I want to pick up on that. We're going to see you in 2 weeks, I think. We're going to do this, the second and fourth Mondays?
Yeah, if you guys will have me, I love doing this.
So I want to pick up on that, and I want to ask you, too, next time, should people be doing their taxes on their own, or should they be hiring somebody to do their taxes? We'll get your thoughts on that.
Sounds good.
Good to see you.
Good to see you.
Great information as always, Gary.
Thank you, Luke. Thank you for having me.